Welcome back, everyone. Eric Freeman here, CPA. And today I'm going to talk about make money when you buy, not when you sell. And really what I'm going to talk about is building equity and why that's not taxed. And so why it's very important to pay attention to the equity that you have, which essentially means the value. So the value of something less whatever debt you may have associated with it is your equity. So the first way that you build equity in real estate is you buy something that's undervalued. And guess what? It's not taxed. The other way that you can build equity that's tax-free is increasing the value of property. So income property is based on the stream of cash flows that you're going to receive from it, whether it's commercial or residential. It's all derived off the cash flow, right? And then you back into, based on the cap rate, what the value of that property is. So what that means is if you can increase the cash flow, you've increased the value. And you are analyzing a property, you look at how do I increase the income? You can do that in various ways. Maybe it has had a lot of long-term tenants and rents haven't been increased for many years. You can raise them to market. That's one way to increase the value. Maybe have a washer and dryers in the unit and you have a relatively easy way to convert it so that you can put those in the units and now people are willing to pay more. And when you do that and you've increased the value, again, all that equity that you've built is tax-free. And it gets even better than that because once you've built that equity, you can now go back to the bank. I've increased the value. My loan now represents maybe 50% of the value. I want a loan for 75%. And the bank will give you a new loan and you take that out and now you can just replicate that. Really important to not look at a property and just say, it is what it is, market, buy for it and hope for some kind of appreciation. You really have to look at it. And again, you make the money when you buy, not when you sell. Of course, you may not cash out until you sell, but you've got the equity there, and that's what's important. You also get depreciation deductions when you buy something, and maybe your cash flow is not actually taxed because of these depreciation deductions, especially if you refinance and you increase your mortgage interest expense. So that's another deduction. Then now all of a sudden you could have tax-free cash flow for a while, plus have some refinance proceeds to put into another investment. When you're tax planning, it's not just about the forms and the numbers and figuring out where, your tax bracket is and all of that complicated stuff that, I get paid to deal with, but it's really also about planning for your investments and knowing ahead of time what will be taxable or not taxable